are jumping straight into an analysis report on our desk.
Let's do it.
In a nutshell, this report details the really dramatic revaluation of Hut 8 Corp. That's HUT after its big pivot.
From a Bitcoin miner to an AI infrastructure provider.
Exactly. A huge shift.
And it's probably the most important story in the digital infrastructure space right now. The submission does a great job isolating the catalysts, but, I think we can make the argument airtight.
Absolutely. So let's start there. The first major area.
Okay.
The report summarizes the old bear premise pretty well. Wall Street was wrong because they just saw Hut as a pure Bitcoin miner.
Right. They ignored the power assets. They were skeptical about the debt, the merger with US Bitcoin Corp, all of that.
That context is good, but the dismissals of that whole bear thesis, it feels like it could be stronger. It's not enough to just say they were wrong because the stock went up. We need to show why those original concerns are now invalid.
Yes, that's the heart of it. Have we really convinced a skeptical reader that the merger instability is solved? Or is it just being, papered over by a big flashy AI contract?
I see the gap. The analysis says the bears were wrong because they missed the AI pivot, but it doesn't really dismantle the structural worries that got Hut that low valuation in the first place.
Exactly. That's the weakness here. The report identifies the old arguments, the merger doubt, the debt load, all those operational questions, but it doesn't give us the specific data on how these new AI contracts actually resolve those issues. Shifting the story doesn't just magically erase the financial instability that was priced in. A sharp analyst is still going to be digging for that.
So the real challenge is proving the AI pivot isn't just about growth. It's also about fixing the balance sheet.
That's it.
For a company that just went through a messy merger, what specific metrics should the analysis use to really prove that stability is back?
Well, you have to focus on what measures certainty. So the suggestion here is to integrate a specific, forward-looking financial assessment.
Okay.
Show exactly how this new contractual, stable revenue stream stabilizes the balance sheet, in the short term. The analysis needs to directly tackle those old debt and operational concerns.
Quantify their reduction.
Quantify it. You have to prove this pivot doesn't just promise growth tomorrow. It cleans up the mess from yesterday that was holding the stock down.
That's a critical distinction, because debt on its own isn't the problem, right? It's debt backed by volatile crypto revenue that's the problem.
Exactly.
So you're saying we need to show the AI revenue has fundamentally de-risked that debt?
Absolutely. That is the leverage point. We can use the numbers already in the report to do it. So, for a concrete example, instead of just saying, hey, they had $50.6 million in net income in Q3, which is great.
Right.
Show how the steady cash flow from the Anthropic or Google contracts will specifically improve the debt-to-equity ratio or the capital expenditure coverage. Do it over the next, say, 12 to 18 months.
So you change the perception of the debt.
You change it completely. It goes from being a liability backed by volatility to a strategic asset backed by guaranteed long-term contracts.
You could even model the reduction in operational risk.
That's another great move. Model it. Show a quantifiable drop in risk compared to just relying on Bitcoin's price swings. Once you show the company's foundation has shifted to stability, the bull thesis becomes, well, almost bulletproof.
Yeah, that takes it beyond just AI hype and into strategic finance. It says the foundation is solid now because the quality of the revenue has changed.
Precisely. And speaking of hype, let's talk about the valuations.
Okay, Section 2. The report rightly flags the core catalyst here. The massive $7 billion revenue opportunity over 15 years from the Anthropic deal.
And the analyst upgrades that followed. Craig Hallam to $80, KBBW to $55. Huge numbers.
They do. It's fascinating, but this is where the narrative needs to be tightened. The analysis has to clearly separate the massive 15-year revenue opportunity from the immediate realized financial impact.
Right, hold on. Isn't the market always forward-looking? I mean, the contracts are signed. They're real. Why focus on execution milestones right now instead of just letting the market price in that future cash flow?
That's a fair challenge. The issue is the sheer scale of the gap.
What do you mean?
The weakness is that the report just leaps from this huge long-term opportunity, which, what does that average out to? About $467 million a year?
Right. It leaps from that to these explosive short-term price targets of $55 or $80 without detailing the execution timeline. There's a huge valuation gap between their last reported revenue, what was it, $83.5 million in Q3?
Yeah, something like that.
And the value these targets imply should exist today. The market is forward-looking, sure, but it's skeptical of potential. It pays a premium for demonstrated execution.
I see. So the jump from here to there feels like it's missing a bridge. An investor needs to know what they're paying for now in terms of what's actually up and running.
Yes, exactly. So the suggestion is this. The analysis needs to introduce key capacity deployment milestones.
Milestones.
Yes, milestones that connect the immediate execution to those valuation increases. The report should define what slice of that 2.3 gigawatts of power is being used right now versus what's a future build-out. That's what justifies the analyst price targets.
So the price targets themselves become markers for operational goals.
They become signposts.
How would you map that out effectively in the analysis?
You have to anchor them. Give concrete examples. For instance, clarify that the, say, $55 price target corresponds to the successful deployment of the first 500 megawatts of AI capacity.
Okay.
Then you could suggest the $80 target is contingent on them securing financing for and starting the next 1 gigawatt expansion. You're basically creating an operational roadmap for the stock price.
A quantifiable one.
Right. And you could also focus on the cash flow from the Anthropic partnership just in the first 12 months. Compare that directly to the old mining revenue. That gives you a tangible, immediate metric for the revaluation.
That's so much stronger. It makes the prediction a function of execution, not just announcement hype. It gives the reader something real to track.
It stabilizes the whole narrative.
Okay, moving on to the third area. The report correctly notes that the bears gave Hut 8 zero value for its massive power capacity, up to 2.3 gigawatts, until the AI deal was announced.
And that is the ultimate miss by Wall Street. It's the most compelling, unique part of this whole story. The analysis has to leverage the rarity of that power capacity as the central unrecognized asset. That's the foundation for the whole argument.
And we're in an era where AI compute demand is just exploding. It's far outstripping the available power. Permitted, connected power at this scale. It's not just an asset anymore. It's a strategic resource.
That resource has to be the protagonist of this story. The weakness of the current report is that it treats the 2.3 gigawatts as just an ignored asset.
An afterthought?
An afterthought. We need to flip that. Position it as the single primary proprietary asset, a scarce commodity that enabled these high-margin deals in the first place. The analysis puts the AI deals first, which makes the power seem like a consequence.
It needs to be the cause.
It has to be the cause.
That completely reframes the company's identity. It's not just another beneficiary of the AI boom. It's a core infrastructure provider for the boom because of its unique energy position.
That is the exact shift that's needed. So the suggestion is to restructure the whole argument. Lead with the strategic scarcity of the power.
Okay.
Frame the pivot not as a reaction to, crypto volatility, but as a strategic, long-term monetization of a proprietary energy asset that finally found its perfect customer.
A customer willing to pay a premium for it.
A very high-paying customer, hyperscale AI compute. This makes the bull thesis unique to Hut 8. It's not just another miner trying to repurpose old gear.
That power capacity is the moat. It's the barrier to entry that competitors can't just replicate. We have to emphasize that 2.3 gigawatts isn't just a big number. It's a scale that almost nobody else in the sector has ready to go.
Absolutely. And you can use the market's own reaction as proof. For a concrete example, emphasize that the Google Financial Guarantee, the long-term leases, that's third-party validation of the reliability and scale of these power assets.
Right?
The report should dedicate real space to why 2.3 gigawatts is strategically perfect for hyperscale AI, which needs massive, reliable power. And then you use the technicals.
The stock chart.
Use the chart. That moment the stock smashed through $40 resistance, the institutional buying that followed, use that as evidence that the market finally understood the intrinsic value of the power. It ties the technical move directly to the fundamental scarcity.
That creates such a tight, persuasive structure. It makes the technical breakout a direct result of the market realizing the value of a physical, finite, proprietary asset.
It leaves no doubt. The revaluation is grounded in something real, not just projections. It solidifies the whole thing.
This has been a really deep dive. Fundamentally, it's a very strong piece of analysis that caught a huge market shift,